If you gave money to charity last year, or let's say your church, this video is for you, especially if that money came straight out of your checking or savings account. I'm Nick George, a certified financial planner, and I want to share with you a strategy that can make your giving go a lot further without you writing a bigger check. Let me tell you about a couple. We'll call them Sarah and Jim. Every year, Sarah and Jim give $10,000 to their church. They send the money, feel good about it, and move on. I mean, they should feel good about it. Generosity is a great thing. But a question they have never even thought of until I mentioned it was, is that the best way to give? Surely there's not a wrong way to give, right? But you'll see what I mean. Rewind with me to January. Sarah and Jim are sitting across from me, and I eventually asked them if they give to any charities. Sarah lights up, tells me about their church and how much it means to them and how they transfer $10,000 from their checking account to their church every year, like clockwork. I love and appreciate their generosity, and I'm sure the church does as well. And I'm glad I did, because that's when I kind of semi-rhetorically asked if this was the best way to give, not expecting a real answer, but more so to share with them this alternative idea. And the idea is this: instead of giving cash, you give stock, specifically stock that's gone up in value since you bought it. That's the core idea. Because normally when you sell stock that's gone up, you get taxed on the gain. That's called capital gains tax. And depending on your income, it can range somewhere between 15 and 24%. But if you give the stock directly to a charity or to a nonprofit organization like a church, instead of selling it, you skip that tax entirely. So the charity gets the full value, you get a deduction for the full value, and the capital gain you were going to owe tax on someday is now gone. Let me show you what I mean with Sarah and Jim. Years ago, they bought Apple stock. They bought 50 shares of Apple stock. It was about $2,000 total at the time. And over time, that investment grew. And today it's worth $10,000. So those 50 shares went from 2,000 to 10,000. And sitting inside that position is this $8,000 capital gain. Now we already know they plan to give $10,000 to their church this year. That decision isn't changing. The only thing we're looking at is how they fund it. Now, option one is what they've always done. They send $10,000 from their bank account to their church and don't touch the Apple stock. That's just continuing to sit there with that $8,000 gain potentially increasing over time. Option two is, instead of sending cash, they transfer those shares of Apple stock directly to their church. So the church receives $10,000 worth of Apple stock. They immediately sell it. And because they're a nonprofit, they don't pay tax on that gain. And neither does Sarah and Jim. Nobody pays tax on that gain. Pretty cool, right? Now, Jim loves the idea, but he does not want to get rid of the Apple stock he bought years ago. It's done well for them and they just don't want to get rid of it. And I mentioned to Jim, if they still want to own Apple stock, they absolutely can. We'll just take that $10,000 from your bank account, this cash that you're going to give to the church, but instead we're going to transfer it to your investment account and buy Apple again. We can buy the same 50 shares worth about $10,000 today. So they're right back where they were in terms of ownership. But now their cost basis is $10,000 instead of $2,000. So we're still holding the same amount of Apple. We just reset their cost basis. That $8,000 gain that used to be sitting in there is now gone. And at a 15% capital gains rate, that's about $1,200 of tax they have now avoided without changing the number they gave. It's that same $10,000 gift, just now a different outcome. Well, of course, the bigger the gift, the bigger the impact. Now, if you're only giving a few $100s a year, which is great, any generosity is a beautiful thing. While this technically is available, the juice probably isn't worth the squeeze. It's a lot of effort to do this, and you do get some advantages of giving cash. But once you're consistently giving $5,000 or more, it definitely starts to become something worth paying attention to. And when you get into the $25,000, $50,000, and above $100,000 annual giving amounts, well, then this becomes a very meaningful strategy. I've sat down with business owners and we'll call them retired executives who were writing huge checks to charity every year, all while sitting on investment accounts full of appreciated stock. Nobody showed them an alternative that resulted in less money going to Uncle Sam. That's it. which is, in my opinion, a win for everyone. Now let's fast forward a few more years, and Sarah and Jim are a bit older now, and I've gotten to know them pretty well at this point. And Jim mentions to me that he's expecting to receive a pretty high bonus this year. And this felt like the perfect moment to share with them 2 additional giving strategies. And I'll keep these high level because if either one of these apply to you, it's best to talk to your advisor to go further. But the first is called a donor advised fund, or a DAF, DAF. And the easiest way to think about a DAF, or a donor advised fund, is this separate account specifically for giving, almost like a charitable savings account. Instead of giving $10,000 a year directly to their church, Sarah and Jim could take several years of plain giving and do it all at once. So after a few discussions, they decided to take 5 years worth of giving, $50,000, and transfer appreciated stock along with a little bit of cash into a donor advised fund in 1 year. That gives them the full tax deduction right now, but they don't have to send all $50,000 out. They can still give $10,000 each year to their church, just like they always have. The only difference is now these gifts are coming from their donor advised fund instead of their checking account or investment account. From the church's perspective, nothing changes. But from Sarah and Jim's perspective, they have now pulled forward the tax benefit into a year where it matters much more. In this year where Jim is going to receive this big bonus and have the highest income year they've ever had. And it's going to save them thousands of dollars in taxes. I then briefly mentioned this second strategy, which comes into play a little later. It's called a qualified charitable distribution, or a QCD. Once someone is 70 and a half or older and they have an IRA, an individual retirement account, they can send money directly from that IRA to a charity. Now that distribution does not show up as taxable income. When Sarah and Jim are taking required minimum distributions, it counts toward that as well. And when you take money out of an IRA, that money is taxed as income, which is quite a bit different than money taxed as capital gains. And what this ends up looking like for Sarah and Jim is this. We use the donor advised fund today to cover the next 5 years of giving, and we get this big tax deduction in a meaningful year. And after 5 years, well, guess what? Jim is right around age 70. And from that point forward, their giving can now be taken from an IRA using qualified charitable distributions. And for people who have an IRA and are consistently giving in retirement, this is one of the best ways to do it. A few recent rule changes make this conversation even more relevant now. When Congress passed the One Big Beautiful Bill Act, it changed some of the rules around charitable giving starting this year in 2026. And at a high level, here are 3 things that every donor should know. First and foremost, there's a new floor for itemizers. So if you itemize your deductions, you can only deduct charitable gifts to the extent they exceed 0.5% of your adjusted gross income. Now that was a mouthful. Like, what the heck does that mean? Well, if your adjusted gross income is $400,000 as a household, 0.5% of that is $2,000. So if you only gave $2,000 to charity, you receive no deduction at all. It's almost like a deductible on insurance. So in other words, you have to clear that floor before the tax benefit kicks in. Second, for the highest earners, those that are in the 37% tax bracket, which is the highest tax bracket, the tax benefit of charitable deductions is now capped at 35%, or 35 cents on the dollar instead of 37 cents. This is a small change, but if you're giving a lot of money, this can add up. Last but certainly not least, and this is good news for everyone taking the standard deduction, you can now deduct up to $1,000 if you're single, $2,000 if you're married, for any cash gifts to public charities. This is brand new as of this year, and this deduction is regardless if you itemize or not. It's what we call an above the line deduction. Now, before I leave you, here are 4 mistakes to avoid. First, and this is very important, make sure that the stock you're donating has been held more than a year. We want long-term capital gain status. Second, and this is equally as important, do not sell the stock first. You must transfer the shares first and directly. The charity or the church sells them, not you. Remember that. We're doing a legitimate transfer. And third, give yourself some time. Since we are doing a direct transfer, this process operationally takes time. And fourth, just keep good records. For any non-cash gift over $500, you need to tell the IRS. And you do this by filing Form 8283. and you do this with your tax return. With Sarah and Jim, nothing really changed on the surface, right? They just used a different asset to do it, and that one change saved them over $1,000 in taxes. If you're someone who gives regularly and also has built up investments over time, this is absolutely something worth looking at. If you want help thinking through it, give me a shout. We'd be happy to brainstorm with you. Until next time, my friends.